All right, let's focus on the healthcare and pharma space. Ekta is standing by with the report card for Q1. Ekta, over to you.
Well, yes, Q1 FY23 threw up some interesting trends in the pharma and the healthcare space. While healthcare companies such as hospitals did meet expectations, the India generic companies' performance was weak. In fact, Jefferies in their note points out that the largest miss in Q1 FY23 was from pharma companies, primarily on account of US price erosion. The US pressure in the markets combined with factors such as higher raw material costs resulted in margins being weighed down in Q1. Companies such as Lupin, Alembic and Alchem reported some of the lowest margins ever in the quarter gone by. On the other hand, hospitals within the healthcare segment met analyst expectations. Factors such as occupancies normalizing, price hikes, higher surgical and payer mix, international flights resuming resulted in parameters such as the average revenue per occupied bed, hence margins improving. In fact, hospitals on an average saw high single to double digit sales growth and 200 to 350 basis points margin improvement sequentially. So is this dichotomy in the performance expected to continue? For hospitals, analysts point out the outlook is likely to remain healthy due to factors such as occupancies looking to rise going forward, also along with the case mix and the payer profiles improving further. While for generic pharma companies, recovery is possible only in the next 1 to 2 quarters or 1 to 2 quarters away. So is the preference shifting? For some, yes. Jefferies' pecking order now is hospitals, followed by contract drug manufacturing companies, and finally, generic companies. Similarly, a healthcare fund manager says their preference is in all domestic focused stories, from hospitals and diagnostics to API companies, which could benefit from the China +1 factor. And yes, while US generic companies are likely to continue facing headwinds such as price pressure, input cost inflation to risks from the US FDA's inspections or litigations, the advice from some is not to entirely avoid the play, but to be selective. HSBC, for example, likes pharma companies that, according to them, are moving up the value chain and have near to medium-term drivers. They like stocks such as Cipla due to their pipeline of US launches, and Sun Pharma, which is on improving profitability in their specialty product sales. Lastly, while healthcare companies might be emerging as a preference, it is important to highlight the risks. Diagnostic companies, which are a healthcare play, are seeing stiff competition, which is pulling down margins. An example was Fortis's margins being pulled lower due to their pathology arm in Q1. Similarly, investments in new verticals, for example, Apollo Hospitals, increased their 24/7 investments, leading to EBITDA loss in the division. A strategic investor, a scale-up of the arm will be a key factor to watch going forward.
All right, Ekta, thanks a lot for getting us that complete report card on how pharma and the healthcare space has fared in Q1. With that, we're going to slip into